Thanks so much for tuning into this conversation. It's always a special occasion to talk to Mr. Seshagiri Rao for getting a sense of not just what JSW Steel as a company did in the quarter gone by, but also about where does he see the cycle to be like, especially in light of the fact that 2023 might be different for the metal space because China is opening up or has opened up. Their own revenues and operational metrics were largely in line with what Bloomberg estimates were, maybe marginally ahead. On the bottom line front, below what the estimates were. Let's get him in on the conversation to talk about all of that. Mr. Rao, great having you. Thanks for joining in.
My pleasure. Thank you.
How do you sum up the quarter? I thought on the operational metrics, it stayed largely in line, though some brokerages said that they may be expected to do a little bit more. But as per Bloomberg consensus estimates, both on the revenue front and the operational metrics, they were largely in line.
Yeah, it was a very challenging quarter. The export tax was removed only in the latter part of November. So it was very difficult to do the exports. And at the same time, export markets were not very conducive. So in these circumstances, doing a sales volume of over 5 million ton is in fact very commendable. It was the highest ever production we have made in the last quarter and the highest ever domestic sales we have made in the last quarter. In spite of fall in net sales realizations, I think costs have given us benefit of reducing the cost and then improving the EBITDA margin by almost over 5,000 rupees. And the last item in our performance was the turnaround, particularly in Italy, where we have made 7.8 million euro EBITDA from 1 million in the sequential quarter. And also US reduced the losses in spite of very, very difficult conditions in the US. So overall, I think the domestic subsidiaries and overseas subsidiaries together contributed 517 crores as against a loss in the previous quarter. So all this together, I think, has done a remarkable recovery in the Q3 over Q2. It appears to be lower compared year on year. Last year was an exceptional year. That's why you find a fall in the EBITDA and net profits compared to the last year. But compared to sequential, I think we have done extremely well.
This realizations being a tad bit weaker than what people thought of and maybe what you also thought of. How do you think that picture progresses over the course of this quarter or the first half, especially also in light of the fact that China is, opened up?
Yeah, there is a lot of uncertainty as far as the global growth is concerned. That is what we are hearing the stories. So with that, next year, assuming that the demand will recover globally for steel, I don't think that may be the right assumption. Even in the year 2022 calendar year, the steel production came down by 80 million tons, which is almost close to 4% fall in production. That is in line with the fall in demand in various regions. Out of this 80 million, 20 million is from China and 60 million from the rest of the world. That means there is a huge amount of correction in production which was happening. So in line with the fall in demand and fall in production, fall in raw material prices, we have seen correction in steel prices almost up to December. But the trigger really is the China reopening. So after that trigger which has come into news, we have seen a bit revival as far as the overall sentiment is concerned. The steel prices really went up for almost $100 to $150 across the regions. So that is one big trigger which we are seeing. But overall steel demand for the calendar year 2023 is concerned is not very optimistic. Maybe a slight improvement over 2022 you can see.
So, Mr. Rao, please tell me, how do you think of this? There is, I was reading, I think last month, an S&P Platts note, which assumed that China's steel demand will stay lower. Some of the capacity which was postponed due to COVID might come on stream, and there, if the production is not under control, then China opening up will actually not lead to prices going higher. If anything, prices could remain under pressure, especially in light of the fact that the West is undergoing a slowdown period. How do you think about this scenario?
So the commentary from the Chinese government is very clear. This time, even after opening up of the economy, assuming that the COVID will come under control as far as the China is concerned, is that it will be consumption-led growth than the investment-led growth. That is one. Number two is the property sector. The issues in China is more of structural in nature. So it takes a long time for revival in the property sector, which constitute almost 30% of the GDP and also big consumer of steel. So your point is absolutely right that considering even revival will be as expected lines, the Chinese GDP may be higher, but the steel consumption may not grow even in China. But it will be a positive news as far as the big economy like China, second largest, is growing. It is a positive news. But the overall steel demand, I don't think that will be driven by China in the year 2023. But what is interesting is, in spite of a 20 million ton fall in the production in the last year, Chinese have not exported more. They kept the exports at the same level as that of last year. They reduced the imports and the production was lower by 20 million tons. So they adjusted the demand. So we expect the same thing. The Chinese had the experience of trade remedial actions if they dump the steel in the rest of the world. I don't think they will do that. So they will be moderating the production in case the steel demand comes down in China.
So you don't see the 2015-16 kind of export numbers from China in 2023?
That we have not seen since 2016 after that experience. Even in 2022, when the steel demand fell globally, we have not seen Chinese dumping steel in the international markets.
Got it. So therefore, how does it augur to your mind, sir, for trends in 2023 for the largest steel company like yours, both domestic demand, because there's a lot of fanfare around setting up shop in India. One, do you pencil that in your assumptions? And two, also export from India to the West, if you will, considering that Europe is in doldrums and the US isn't out of the woods as yet, even if the early signs are there that the economy may be stabilizing.
Yeah. I think India, we have to look at it a little differently. Whatever I just explained about a little pessimistic scenario as far as the global economy is concerned, Indian economy is doing extremely well, particularly steel sector. In the first 9 months of the year, the steel demand went up by 9 million tons, at least almost 1 million ton every month is the incremental demand. So this is expected to further accelerate as far as the Q4 is concerned. We end this year steel demand 118 million tons, as against 106 million ton last year. So it is almost 12 million ton more steel demand in India compared to previous year. So that is the kind of growth we are seeing. This is driven by various sectors. It is not restricted only to the government expenditure here. Even the auto sector is doing well. Capital good industry is doing well. Residential construction, we are seeing a big revival. So there are a lot of sectors which are contributing for the growth in steel demand. So even next financial year, we are seeing a similar trend as far as the India's steel consumption is concerned. At least we expect 10 million ton plus incremental demand in India. And at the same time, when 15% export duty is removed, there are certain pockets of growth in steel demand globally. So there is MENA region, if I take, or in the ASEAN 5, like Indonesia, Philippines, Malaysia, Thailand, and Vietnam, there is a positive demand we are seeing. Similarly, Latin America, and at the same time, Europe, if somebody watches the numbers, even though steel demand has come down, steel production has come down, but their imports more or less remain the same. So there is an opportunity for India to fill up that imports gap which is there today. So that way, there are certain pockets where Indian steel companies can compete effectively in the international market and increase overall exports relative to the current financial year and next year. So growing domestic demand and opening up of some sectors, some countries for India to export. These two together, I look at very positively as for the next financial year and also Q4 for Indian steel companies.
That's an interesting point you make, Mr. Rao. Why would Europe's? I'm just trying to understand why would Europe's imports be what they are? Part one, is it because production facilities out there might be shelved because of higher costs, etc.? And do you reckon that scenario might stay true that way if, God forbid, the conflict doesn't see resolution?
Yeah, what we are observing is the cost of production really has gone up as far as the Europe is concerned. It is becoming more and more unviable to continue to produce and sell at those prices. Not only the energy prices, labor cost also has gone up very high. And also carbon emission side, the kind of regulation that is changing in Europe is also discouraging to continue to produce steel through traditional conventional route of steel making. So all this together, we are seeing an opportunity to export to Europe. Particularly when we see the numbers of the last calendar year, it has not come down drastically.
Got it. Sir, there are other pieces around India, and you spoke about the market scenario. What do you feel about the current utilizations versus the capacities being added, not only you and Tata Steel and SAIL, but ArcelorMittal also setting up a large shop here. How does that augur for the medium term?
So if you see the announcements and then look at the overall scenario, it appears to be that the supply is more than the demand, but that is not the case. Whatever announcements that have been made, you have to see the production when it is coming into the market. That is more relevant to see the demand supply scenario. So if I look at FY24, let's say next 12 months time, JSW Steel has the capacity which has been commissioned in this year and it will become fully available for the entire next year. So when we are saying in this year we will produce 22.6 million ton or 23.6 million ton of steel, other than JSW specialty steel product, that is Monnet Ispat and also Ohio. If I exclude that, then 23.6 million ton is the production guidance we have given for the current financial year, which we will achieve. Whereas our total capacity will be 28 million tons. So there is more capacity available to operate and then bring more production in the next year. If I look at JSW Steel and if I see the competition, the only capacity that may be additional coming in is 3 million ton of Nagarnar plant of NMDC. Other than that, we are not seeing any big production that is coming into market incrementally for FY24. So FY25, if I just go a little beyond, then JSW Steel again announced 9 million ton expansion. That will come into operation for the following year. So we have additional volumes. By that time, there may be some more capacities from other competitors like Tata's and also JSPL can come into market. But if you see the total together versus the incremental demand of 10 to 12 million ton every year, I don't think there is an issue at all. 154 million ton is the installed capacity today in steel industry. Against 154 million ton, we will be producing close to 128 million ton in this year. So there is not much capacity that is left out really to meet the growing demand in India. More capacity is required. So year by year, if I put the capacities that will come into market and the incremental demand, I think it will match and there is a big opportunity for creating more capacities in India.
Lovely. So my final question, and that is around the assumptions that people are making for not just your company, but for the industry at large around the operational metrics for the year. Now, post your numbers coming out, almost all analysts are penciling in lower EBITDA margins from your end for a better part of for FY24 and some part of FY25 as well. Now, it's too long a time frame, I reckon, to judge because it's a very choppy and volatile environment. I'm still trying to understand from what you've clocked in Q3, Mr. Rao. Do you reckon things can stabilize at these levels, or is there a chance of some more downside on the operational metrics or the margins front?
Margins lower means with reference to what we are comparing the margins. That is what is important. If you compare the margins for the last financial year, which was exceptional year, it's not only steel, JSW Steel and every steel company made exceptional margins last year. So those margins, is it possible to reach again? No, I don't think so. It is possible. But if you ask me Q3 EBITDA or Q2 EBITDA or Q1 EBITDA per ton, if you look at it, there is a huge scope for improving our EBITDA margins in future, notwithstanding the steel prices may not go up further. Why I am saying so is that one is rich product mix. We have commissioned a huge amount of downstream units. It's almost close to 12 million tons of downstream we have. And that facilities will be fully available to us. That is one. Number two, our capacities are going up. So our fixed cost per ton will come down. Number two. Number three is the facilities we created on cost reduction side, either iron ore mining equipment or if we say coke oven plant we have commissioned at Vijayanagar, or the power plants at Dolvi. All these cost reducing projects, our costs will come down substantially because of these projects. So one side cost reduction will happen, another side product mix enrichment is happening. Third is volumes are coming in. With that, I think there is a scope for improving the EBITDA margins, what we have seen in the past, even though the steel prices remain stable.
Okay, so at around, whether we take EBITDA per ton or EBITDA margins reported of 11.6%, I'm not taking into account the 29%. I'm saying from the 11.5% that you've clocked in Q3, you reckon if anything, there's a scope for these to move up as opposed to coming off over the course of the year as an average?
Correct. And one more important point is we have exceptional losses also in this year. like FX loss, rupee depreciated by 7 rupees per ton, and also inventory losses because fall in steel prices and raw material prices, we had taken a huge amount of inventory loss. Total together for 9 months was 4,350 crores. It is a huge sum. This won't be there in future. So to that extent, EBITDA margins, I think, is to be restated, adding to actual EBITDA which we have got, plus these losses which will not be there in future. That itself get reinstated, plus the additional which can come in because of product mix and cost reduction.
Well, that'll be music to the ears of anybody who's a bull on the steel cycle and JSW Steel in particular. Mr. Rao, always lovely talking to you. Thank you so much for taking the time out today as well.
Thank you. Thank you, Neeraj. Thank you very much.
Now, the pleasure is ours. Viewers, thanks for tuning in.